Okay, let's begin chapter 30. And in this chapter, we're going to talk about the financial sector and how the financial sector is so important to the economy. So, chapter goals. One, we want to explain why the financial sector is central to almost all macroeconomic debates. The financial sector, even though it really doesn't have physical existence, we could say. Financial assets don't physically exist. They still are hugely important to the economy because they help us organize the real side of the economy. Demonstrate graphically how long-term interest rates are determined. Explain what money is. We'll talk a little bit about money. We'll talk a little bit about the three functions of money. We want to state alternative measures of money, so we'll talk about that a very little bit. We'll explain how banks create money, how in general the financial system creates money, and calculate both a simple money multiplier and the money multiplier. So we'll talk a little bit about how this fractional reserve banking system that we use can actually create money. Explain why people hold money and how short-term interest rates are determined in the money market. Well, we'll try. This is actually a big question. It's a very much an open question in monetary economics, is explaining this demand for money. It's quite difficult. So, the financial sector and the economy. The financial sector is central to almost all the macroeconomic debates that we have. Why? Well, because the financial sector's main purpose is to help us organize the real side of the economy. Even though, nobody is going to derive any utility whatsoever from a particular financial asset. I just don't care about those bankers' acceptances. But what that banker's acceptance allows me to do, or what that savings deposit or checking account allows me to do, is extraordinarily important in allowing the macroeconomy to run smoothly. So we can divide the economy up into basically two sections. The real sector, this is the market for actual goods and services. Right, actual haircuts, actual steaks, actual cars and trains and transportation, all those things that the economy actually produces. And then there's the financial sector. And the financial sector really is made to help us organize this real sector. If you take money in banking, I'll discuss the 6 functions of the financial sector. And those 6 functions include things such as getting the resources from the places and the people where they're at and who have them to the places and people who need them. So a financial asset includes money, stocks, bonds, any of these claims to wealth that are within the financial system. And this is really the key, organizing and coordinating our economy. This is how we do it. So for every real transaction, there's a financial transaction that mirrors it. All right. Well, why would I say that? Well, what if I just go to the store and I pay cash for something? Well, I've just exchanged a financial asset, money, for a good of some kind. All right. Well, you could say, well, wait a minute. What about barter? What if I had straight barter and I just go in and I decide, all right, I need a peanut butter and jelly sandwich, and what I have is a tuna fish salad sandwich, and my friend has a peanut butter and jelly sandwich and really wants a tuna, and we just trade. Well, okay. So maybe in the case of pure barter, we may be able to avoid any kind of a financial transaction involved. But that's a very, very tiny part of the economy. Almost all of the economy is based on this using of some kind of financial asset to facilitate trade. All right, the financial sector, a very important part here is that it channels savings back into spending. So if I have resources, extra resources for this month, I don't want to spend them, so I save them. Now I have 2 choices. I can either save them at the bank, say in a savings account, or I can save them in a shoebox and put them underneath my bed. Well, if I save them in a shoebox, then nothing can happen to them. All right, it's just there. That resources that are represented by those financial assets cannot be used. If I put them in a savings account, then that bank acts as a financial intermediary lending to those who don't have enough resources to do whatever idea they have, using the money that I have because I had a little extra, right? So it channels that savings back into spending. For every financial asset, there's a corresponding financial liability. And this goes back to, if we just remember basic accounting, there's a balance sheet. All right. If there's financial asset here, this is a liability someplace else. So for example, let's say I deposit $100 into a checking account at my bank. Then for me, that $100 checking account is an asset. For my bank, that $100 checking account is a liability. And the two offset in aggregate. So let's define. Financial assets are assets such as stocks or bonds whose benefit to the owner depends on the issuer of the asset meeting a certain obligation. Yeah, sure. All right, if we think about this, let's say I buy an iPad. All right, I don't care what happens to Apple. All I care is that my iPad works, and the functioning of my iPad provides me utility. However, if I bought Apple stock, then I care about how Apple does as a company, because how they do as a company will change how much return I get on that stock. Financial liabilities are obligations by the issuer of a financial asset. So, for example, let's say I decide to issue a bond. All right, so a bond is really just a fancy IOU. It's IOU $100. All right. Well, that for me, I'm the issuer of that, and that is a liability to me because I owe that amount. So, financial institutions channel savings back into spending streams as loans. Let's take a look at this, how this works. So, savings, we can think of that as an outflow from the spending stream. So, if I save $100, that means I don't spend it. And if I just put that underneath my mattress, well then it just doesn't get spent. And so there was that spending stream. It came to me and then it stopped. It leaked out of the economy. All right. This is called outflows in this book. Sometimes in some textbooks it's called a leakage from the economy. All right. Savings deposits, bonds, stocks, and life insurance are forms of saving assets that I could use to store my savings in. Now, let's say instead of putting it in the shoebox, I decide to put it in my savings deposit or my savings account. All right, that increases the amount of resources the bank has in order to lend out. So that bank, right, through this financial institution, right, whatever financial institution, could be an insurance agency, it could be an investment banker, it could be a commercial bank. There's lots of different financial institutions. Makes a loan of some kind to governments, households, or corporations, and that loan then takes that outflow and kicks it back into the economy. And so sometimes we'll call that an inflow, I think in the textbook here, or we might call that an injection into the economy. All right. So these financial institutions channel these savings or these leakages or outflows back into the spending stream as loans. So graphically what we see outflows coming from households. Households have these savings, and these savings go out of the economy. So if this savings didn't go to the financial sector, it would just go to a shoebox, all right, under my bed, and it would just leave the economy, and it would be a leakage that wasn't balanced with an injection. So what then happens? It goes to the financial sector. Let's say I deposit it at the bank. The financial sector issues loans to households, businesses, governments, and that loan becomes an inflow back into the economy. So it kicks it back into the spending stream. So really you can think of financial institutions, or a word that I might use here would be a financial intermediary, because they're intermediate between the savers and the borrowers. Right? They stand in between. They're kind of like a middle person. This financial intermediary, one of their major functions is to be kind of the goalie that kicks the ball back into play.